first estimate for the third quarter GDP came out with an impressive 4.9%, more than double Q2 and near double Q3 last year. As far as we know, personal consumption increased along with strong private domestic investments and strong exports for this quarter. The job market remains strong but unchanged from last month in terms of job opening and unemployment rate, suggesting that equilibrium has been reached. Believing the lagging effect in place is sufficient, the Fed kept the rate constant for a second time, creating additional opportunity for investors hoping to lock in nearly 5% return for mid and long terms. As a result, capital market rates dropped 25 basis points overnight. In October, the overall sentiment was negative, leading to all major equity indices to close the month at a loss, with the biggest drop in the small cap space represented by the Russell 2000s, with negative 6.8% for the month and negative 5.6% for the year. This comes only 3 months after the July rally, when the same index was 13.7% for the year, while the S&P 500 dropped from almost 20% year-to-date in July to a mere 9% year-to-date in October. This drawback almost affected the two most prominent industries of this year. These are semiconductors and home builders. The rally for these industries also peaked in July and retreated since. Expectedly, the PE ratio for the S&P 500 dropped again from July's high of 25 to down to 22.2, keeping in mind that the 20-year average for the PE ratio is about 19.7.